What is basis risk in commodity markets? Have you ever wondered why hedging in commodity markets is not always a foolproof strategy? Let's break down the concept of basis risk and how it plays a role in commodity trading. Basis risk refers to the risk that arises when the price of a futures contract does not move in perfect alignment with the spot price of the actual commodity. This discrepancy can lead to financial exposure, even when hedging is in place. To understand basis risk, we need to look at the term basis. The basis is simply the difference between the spot price of a commodity and the futures price of the contract. The formula is straightforward. Basis equals the spot price of the commodity minus the futures price of the contract. Ideally, when a futures contract expires, the spot and futures prices should converge, eliminating basis risk. However, various factors can prevent this from happening. One major factor is quality differences. The physical commodity being sold may not match the grade or quality of the standardized commodity that the futures contract is based on. For instance, a farmer's crop may not meet the specifications outlined in the futures contract, leading to price discrepancies. Another factor is timing mismatch. The date when the commodity is sold may not align perfectly with the expiration date of the futures contract. This can create price differences over time, adding to the basis risk. Location differences also play a role. The delivery location of the commodity might not match the delivery point specified in the futures contract. Variations in transportation costs, regional supply and demand, and local market conditions can cause spot prices to differ by location, leading to geographic basis risk. Market factors are another contributor. Unexpected changes in supply and demand, weather events, geopolitical developments, or transportation disruptions can cause spot prices and futures prices to diverge. Historically, basis risk has been a challenge since the inception of commodity futures markets. Early exchanges were created to help producers and traders manage price fluctuations. However, the imperfect nature of these contracts means that hedging is not always perfect, and basis risk remains a reality in commodity trading. Basis risk affects everyone involved in commodity markets, from producers to traders and financial institutions. For example, a wheat farmer hedging prices with futures contracts may still face uncertainty if local wheat prices deviate from futures prices due to weather conditions or transportation issues. Similarly, an oil producer hedging with crude oil futures may encounter basis risk if local prices differ from benchmark futures prices. To manage basis risk, market participants can use various strategies. One approach is to select futures contracts that closely match the quality, timing, and location of their physical commodity. Another strategy is to employ options or swaps alongside futures to tailor risk management more effectively. Monitoring basis movements over time can also help participants anticipate and adjust their hedging strategies. Despite these strategies, basis risk cannot be entirely eliminated. It remains a fundamental aspect of commodity markets, reflecting the realities of trading physical goods in diverse environments. Understanding and managing basis risk is essential for anyone involved in commodity trading or production.